there's trading in goods and services. So we're going to be looking at both perspectives there. So I am just going to share my presentation and we'll start to go through. I like to keep these things informal, so if there's a burning question, don't feel like you need to leave it to the end. Just pop it in the chat or the Q&A session, and I don't mind being interrupted. Okay, so I'm just going to share my slides with you. And we will start. Okay, so a little bit about the agenda. So we're going to cover very briefly the facts and how we got here. We're going to look at the trade agreement landscape, both currently and now, and then after the 31st of December. So where has the UK government gotten in terms of its negotiations? We're going to be looking at government measures to date that give us a little bit more clarity around how we can optimally prepare. We look at the regulatory positions, so some of the regulatory impacts that are going to take effect whether or not we have an EU-UK trade agreement. Then we're going to look at trading in goods, both now and beyond the turn of the year. And then we'll flip our hats and look at services. And then we'll maybe discuss a little bit about the current state of play with regard to the trade negotiations. And then importantly, we'll go over kind of like the 60-day action plan. So time really is of the essence. We have a lot more clarity over how we can prepare. And it's really essential that we get on with those preparations now. So hopefully I'll be signposting and giving you pointers as to what you can get on with now. Okay, so facts and how we got to where we are now. So, you know, there's no getting away from it. We are, as neighbours, completely linked. You know, our regulation, our trade has been inextricably linked for the last 40 plus years. You know, the EU as a bloc is our largest trading partner. We have a trade deficit on our goods, but we have a trade surplus on our services. So when we come on to talking about services, you'll see just how important our services exports are to the EU. And you know, there has been much talk about preparing for importers and exporters who trade in goods, but not so much around services. And that frustrates me a little bit, considering we're an 80% services-based economy. Our share of UK exports going into the EU has actually fallen over time, and this is largely due to the fact that we've become a little bit more bold as exporters, and we're starting to look further afield at those emerging markets, those developing nations where their growth is looking particularly attractive, and they have an emerging middle class, quite an affluent middle class, who has a lot of disposable income and recognises UK brands as standing for quality, and has an interest in paying actually a certain amount more for goods that are manufactured in the UK rather than elsewhere. So we've become a little bit bolder as exporters. But in terms of how we've traded within the EU, obviously we paid no tariffs on goods traded between the two territories, if you like. We continue to use the common external tariff until the 31st of December. We're going to touch on the new UK global tariff that takes over from the 1st of January later on in some of the slides. But essentially, if we can't strike a deal between now and the end of the year, and we're really down to the wire, then that will see our trade with the EU default to WTO terms and most favoured nation tariffs on the 1st of January. So it's not a position that either the UK or the EU want to be in. So hence why the negotiations have ramped up quite dramatically over the last 12 days. Okay, so that really talks about the interdependency of us and our EU neighbours. This slide, I suppose, visually depicts the dependence the UK has on the EU market in terms of its imports and exports. So at face value, it looks as though the US is our biggest trading partner, but that's because the member states that make up the EU trading bloc are listed independently. So in fact, UK exports to the EU were 43% of overall UK exports in 2019, and then UK imports from the EU were 51% of UK imports in 2019. So as I mentioned, we operate a trade deficit with the EU in so much as we import more than we export to the bloc, even though we've got that surplus in services. So how we got here, oh my goodness, it seems like an eternity, and I feel like I've lived and breathed Brexit for 4.5 years now. But since the referendum on the 23rd of June, we're 4 years on. The UK government declined to extend the transition period when they had the opportunity back in June, even though we were in the midst of the COVID crisis, but they wanted to press on. So effectively, the transition period does definitively end on the 31st of December. And I think it's fair to say that the two sides are still grappling with what represents a fair and an operable trading relationship moving forward. I think it's important to say that even if a deal is struck this month, and as I say, we're really down to the wire, it could take years to implement, absolutely years to implement. So in the event of no deal being struck, what does that look like? So effectively, we have left the EU. We left the EU on the 31st of January this year. But obviously, throughout the transition period, we have effectively continued to enjoy the kind of freedoms that that membership allows us. So, you know, we've continued to be part of the single market and the customs union. EU content has continued to count towards the rules of origin requirements for our EU trade agreements. And we're going to touch on origin later on. We've still enjoyed all of the, sorry, just 1 second. Oh, what has happened there? Okay, sorry about that, everyone. We still continue to enjoy all of the free trade agreements that the EU has negotiated with countries across the globe. And so life has been, you know, outside of us no longer being represented in EU institutions and bodies, which really, as traders, hasn't really impacted us. It's a case of life has been pretty much the same, if you like. We haven't really noticed any difference. However, if we do leave the EU without a trade agreement in place, obviously we become a third country in the eyes of the EU. That will happen anyway. We lose access to the single market and the customs union. We lose access to those free trade agreements. And we start being responsible for making customs declarations. They become mandatory for trade coming from and going to the EU. So all of our goods that we currently put into free circulation and don't require border controls, checks, certification, licensing, and so on, they will now be subjected to the same kind of controls and screening that applies to third country goods. So it changes quite dramatically overnight. I like this slide because it's important to understand where we're going, where we're coming from and where we're going to. So this image illustrates the current EU trading landscape and the different levels of agreement that the bloc has with countries and other trading blocs. So as part of the EU, during the transition period, we've retained access to these arrangements. So when you think about the different colours denote the different types of agreement that the EU has negotiated. So we've got the equivalent of customs union agreements, which we enjoy with Turkey, for example, where both parties have eliminated customs duties and established kind of like that joint customs tariff for foreign imports. Then we have association agreements and free trade agreements like we do, you know, where both parties have agreed to remove or reduce customs tariffs and regulatory impacts, if you like, in bilateral trade. And then we have partnership and cooperation agreements as well. But on the 1st of January, the UK will no longer have access to what is over 77 countries with a variety of negotiated agreements, facilitating that kind of frictionless bilateral trade. I mean, you think about a government's responsibility in international trade, it's to protect its domestic market, but then it's to strike global agreements with countries where it can offer its traders that frictionless international trade. So the local economy can be boosted in that way. But we lose access to those trade agreements, and also the ones that are in the process have been ratified and negotiated. So what does our future preferential trade agreement look like, or trade landscape look like? So the UK was technically unable to negotiate new trade deals until the transition period, and even then these agreements can't come into effect until the end of this year. So far the government has agreed 22 rollover deals, or what we refer to as continuity agreements, and they cover some 50 plus countries. However, trade with these nations only represent about 10% of the UK's global trade. Now obviously Japan is our 11th largest trading partner and a significant source of foreign direct investment in the UK. So the recent UK-Japan FTA was welcomed not least by the automotive sector, who's have really complex supply chains and are dependent on that free and frictionless trade. So the UK-Japan FTA has been really good news. But overall, I think the government's made quite modest progress, and it in no way compensates for the fact that failure to strike a deal with the EU this month will lead to some 90% of our trade being done under WTO terms. So what has the government been doing to date to prepare? So there are a few key initiatives. So we can all hail back to 2019 when Northern Ireland became the focal point of the withdrawal agreement saga. The result was the production of the Northern Ireland Protocol. So despite many promises from government, the protocol does actually serve to create a legal border down the Irish Sea. Obviously, the overriding principle was to avoid a hard border on the island of Ireland, and it achieves that. So Northern Ireland businesses will have unfettered access, as we're referring to it as, access to GB. But depending on where the goods are moving to and from, they'll be treated slightly differently. So what I mean by that is trade coming from Northern Ireland to the rest of the UK, there'll be no additional processes or any paperwork or restrictions. However, trade going to Northern Ireland from the rest of the UK might face tariffs if those goods are ultimately entering Ireland, or if they're at clear or substantial risk of entering Ireland, rather than staying in Northern Ireland and within the UK customs territory. Now that's just that case. If the goods are staying in Northern Ireland, then there'll be no tariffs levied on those goods because they're staying within the UK customs territory. There'll be undoubtedly additional processes on goods arriving in Northern Ireland from GB, so specifically for animal and plant health or agri-food goods that warrant those specific checks and controls. And these will be implemented in border control posts within Northern Ireland ports. Ports are working furiously to prepare for this burden right now. You'll start to see, I'll certainly refer to it today, but you'll also start to see increasing reference to GB and Northern Ireland as opposed to the UK. And that is because of the Northern Ireland Protocol, because it requires that Northern Ireland remain closely aligned with the EU. And that is a classic example of that alignment. So that is always a tricky area, and I never profess to be an expert, but it's never more tricky than in the case of the Northern Ireland Protocol. So essentially, Northern Ireland will remain aligned with the EU VAT and excise rules for goods to prevent any kind of difference to the treatment of goods across Northern and Southern Ireland. However, Northern Ireland will also remain part of the UK's VAT and excise system. So what that essentially means is that HMRC continues to collect the VAT across the UK, including Northern Ireland, but no longer passes it over to the EU. Hugely complicated stuff. But where you supply goods to Northern Ireland, check with your freight forwarder or parcel operator to see if there are any additional requirements you need to consider. However, if you receive goods from Northern Ireland, there really shouldn't be any change. So there shouldn't be any needs for import customs declarations, entry summary declarations, tariffs, customs checks, all that wonderful stuff. So everything coming into the UK from Northern Ireland is unaffected, but goods going into Northern Ireland from GB may be. So just check your obligations there. The other advancement is the new border operating model or operation model. In July, the government launched this 200-page document. It's great bedtime reading. It's entitled The Border Operating Model, and it was actually just updated last month, so do obtain a copy. I've included the link in some of the supporting documentation at the end. The model lays out the UK's plan for implementing full border controls on EU goods from the 1st of January. So the plan details a phased approach to implementation for importers. In some cases, companies importing standard goods, they can simply fulfill basic customs requirements like keeping records and accounting for VAT, etc. And they could have up to 6 months to complete customs declarations. Now, in that scenario, import duty is still payable, but it can be deferred until the declaration is made. So that can give those importers of standard goods some 6 months to kind of grapple with the new processes of customs declarations and also be able to defer that duty and import VAT, which has an impact on cash flow. However, obligations on UK companies exporting to the EU are immediate, and full declarations will be required from the 1st of January, unless the company's been authorised for a specific simplified procedure. So the two that you could be looking at would be entry in declarant record, or we refer to EIDR, we love our acronyms in international trade, or simplified declaration procedures. But both of those enable you as the exporter to make a simplified declaration to clear your goods for export, and then file a supplementary declaration to HMRC within a defined time frame, which is usually 14 days. So it does alleviate some of the pain. I don't want to go into too much detail around the border operating model, because we've got it's really quite a heavy subject, and we're running a separate webinar exclusively on this, I think next week anyway. But I did want to pick out some key points because they're paramount in terms of preparing. So it effectively has three phases for import, and again, everything is for export, everything is required from day one. But for import, we're looking at 3 key dates, which is the 1st of January, 1st of April, and the 1st of July. So as I said, importers of standard goods, so standard goods are anything from clothes to electronics, they'll need to basically cover customs requirements internally, so keep records, account for VAT and so on. But then those importers will have up to 6 months to complete those customs declarations. So like I said, import duty is payable, but it can be deferred until the declaration is made. UK safety and security declarations won't be required on imports for the first 6 months either, so that's another good piece of news. Now, importers of non-standard goods, so controlled and excise goods, they'll need to make standard customs declarations from the 1st of January, so they don't have the opportunity to defer those. There'll be physical checks on all high-risk live animals and plants, and a requirement to pre-notify for certain movements, but these goods won't have to enter the UK via a border control post. That will happen later on in the phasing. As I mentioned earlier, export declarations and UK exit safety and security declarations will be required for all goods from the 1st of January, so there's no phasing in for our exporters, which I honestly do not understand. However, so the second date is the 1st of April, so that's where all products of animal origin, so for example, they could be products like meat, honey, milk or eggs, and all regulated plants and plant products will also require pre-notification and the relevant health documentation. They'll also be subject to physical checks as well when they enter the UK. And then finally, phase 3 on the 1st of July, or at least that's when it's planned for. Traders moving any goods across the whole spectrum will have to make full customs declarations at the point of importation and pay the relevant tariffs. So anybody that's deferred their declarations and their import duty and VAT will have to have made their supplementary declarations by the 1st of July. So imports subject to sanitary and phytosanitary controls, they'll have to be presented to border control posts. So it may require a rerouting of your goods. There'll also be an increase in physical checks and taking of samples. So there's a lot happening. And I think for companies who have exclusively traded within the EU, these are big changes. So what are the implications and what does it mean for you as business owners overall? So obviously customs declarations as an importer or an exporter or both, you'll have to complete import and export customs declarations. Some locations will require pre-lodgement of customs declarations prior to movement of goods, which obviously has a bit of a knock-on effect for roll-on, roll-off movements. Customs duties, if you're importing, you'll need to ensure that any customs duties applicable to your goods under the new UK global tariff are paid. So you'll need to determine the origin, the classification, and the customs value of your goods. Now, there are options to defer any payment until that's due, like I've just mentioned before, and we'll talk about how you go through that as we move through this presentation. VAT will be levied on imports of goods from the EU following the same rates and structures that are applied currently to rest of the world imports. So if you're already importing from the rest of the world, then you know what to expect. If you're a VAT registered business, you'll be able to use postponed VAT accounting to account for your import VAT. If you're not VAT registered, then you have the same options available to report and pay that import VAT as you do for customs duty. So it's kind of settling up with HMRC as the goods are cleared at customs. Safety and security declarations, they'll need to be made. So the UK government will want to collect more information on goods moving into GB from the EU, and by default this will include safety and security declarations. So it's essential to know what documentation is needed to clear your goods at customs. Are there any license requirements? Are there any certificate requirements? Do you need to pre-notify of a shipment? There are additional requirements, but these affect only a specific number of goods. And they are ones that require special certificates to entry or to enter the UK. So they would be goods that are covered by international conventions, for example, endangered species of wild fauna and flora, any goods subject to sanitary and phytosanitary controls, so animal products, products of animal origin, byproducts, so fish, live animals, organics, any goods with additional customs requirements like excise goods are treated differently, and any what we refer to as strategic exports as well will be treated slightly differently. There is some light at the end of the tunnel. Collection of Intrastat. So HMRC has said that it will continue to require all of you VAT registered businesses currently submitting Intrastat arrivals declarations. So those of you that are bringing goods in from the EU, you have to continue submitting those until the 31st of December next year. As an exporter, or where you've been dispatching your goods to the EU, you no longer have to file those Intrastat declarations beyond the end of this year. So there's some light at the end of the tunnel. Again, the new border operating model, it's a huge topic and it warrants a completely separate webinar. But hopefully I've provided an overview in terms of what's coming and the implications of these. So we move on to the new UK global tariff. So it replaces the EU common external tariff and it'll apply to all of the goods that you import from the 1st of January. So any long-standing importers or exporters on this session, you'll remember the huge paper files of the UK trade tariff. Thankfully, most of us refer now to the online version. But it's a system we've become very comfortable with and instinctively know where to go to find what we need in terms of product classification and conditions and so on. However, on the 31st of December, we'll no longer operate within the EU Customs Union, so the common external tariff ceases to apply to our imports, and it's replaced by the new UK global tariff. The system quite helpfully compares what you pay now and what you'll pay from the 1st of January. So again, I've given the links to both databases at the back of this presentation. There are a couple of exceptions to when the tariff will apply. So for example, when goods you're importing come from a developing country that pays less or no duty because it's part of the generalised system of preference. So the generalised system of preference is a WTO arrangement, so isn't impacted by Brexit. So the UK will continue to be party to this. So if you currently import any goods from those GSP nations and claim preference, that will continue. Also, if you're importing goods from a country that has a trade agreement with the UK or a free trade agreement with the UK, so in that case, in the case of the UK-Japan trade agreement, goods coming in from Japan won't be subject to duties. Or if you're importing goods that have a relief or a tariff suspension that's operated by the UK, they obviously don't incur the duties that are in the tariff. You'll still need to refer to both the UK trade tariff that you've probably become familiar with and the new UK global tariff just in the immediate term for finding commodity codes, preference details, VAT, quotas, any conditions like certificates, licenses, proofs of origin. That's just until HMRC merges both of the two. Okay, I did want to touch on regulation. We're asked frequently and have been over the last few years what we believe will pose the greatest challenge for UK businesses in a no-deal scenario. And there's been so much talk of tariffs. But I believe that it's the regulatory impact that will be most damaging. So the UK, if you think, has aligned its regulation and laws with the EU for over 40 years. Actually, we've been at the forefront of many directives. So extracting ourselves from that framework and replicating it domestically could never have been achieved in the time that we've been afforded. And the truth is that the government still has much to do in this area. So there's been much talk about how we want to negotiate a Canada-style FTA. This causes the EU quite a lot of concern because it actually doubts whether a commercial competitor, as we would be, could really be a close trading partner when it's outside of the trading bloc. So the EU wants close regulatory alignment, but this is obviously difficult for the UK to stomach because so much of Brexit was around taking back regulatory control. So it would be politically difficult for the UK to accept mutual recognition with a dominance of EU standards, but that's arguably what's going to be needed, because how can you remove all of the barriers to trade in goods without maintaining the dominance of existing Europeanized standards in a comprehensive trade agreement or trade relationship? So it's complicated, and much of the remaining stumbling blocks in the negotiation are around this kind of regulatory alignment, if you like. I did want to pick out some of them because ultimately, no matter where negotiations are to date, there can be no denying that there's regulatory changes that are going to happen and they're going to significantly impact businesses. So I've listed just a few examples here. REACH is one I wanted to talk about. So that's the EU's registration platform for chemicals coming into the EU. So manufacturers and importers have a duty to register those products on that system. Now, from the 1st of January, GB-based companies currently registered with EU REACH will no longer be able to sell into the EEA marketplace without transferring their regulations to an organisation based in that marketplace. Now, make the distinction again between the UK and GB-based companies, because under the Northern Ireland Protocol and Northern Ireland's close regulatory alignment with the EU, the process for businesses in Northern Ireland moving goods to and from the European Union under EU REACH won't change. So essentially, GB businesses must now register on the UK REACH platform. In actual fact, it's been grandfathered over, but they still have to access the platform from the 1st of January and add supplementary data. But then they have to take other action to continue accessing the EU marketplace. So there's an impact there. Placing manufactured goods on the EU market is another example. So there are now 3 sets of guidance replacing what was one clear directive, depending on whether you're placing goods on the market in GB, or in Northern Ireland from GB, or in Northern Ireland from the EU. There are significant impacts for harmonised goods, which are those that have been deemed to conform to standards in the official journal. So from the 1st of January, any mandatory conformity assessment will have to be carried out by an EU recognised conformity assessment body, because UK conformity assessment bodies will no longer be able to carry out assessments on products being placed on the EU market. That kind of leads me nicely into the CE mark. So any manufacturers on the call, you'll be familiar with the CE mark. It's that European certification that indicates conformity with health, safety and environmental protection for standards products sold into the EEA. Now, Brexit has implications over where and how that mark can be sold, or how that mark can be used, sorry. The new UK CA mark, which stands for UK Conformity Assessed, will be the new product marking for certain products being placed on the UK market from the 1st of January. So we've created our own conformity assessment mark. The CE marking can still be used here within Great Britain up until the end of next year, after which point the UK CA mark will be a requirement. Now, again, I make the difference between GB as opposed to the UK, because the UK CA marking alone won't be enough to place goods on the Northern Ireland market. In the case of Northern Ireland, you'll need either the CE marking, which is recognised in the EU, or you'll need a UK CA Northern Ireland marking. So To further compound the issue, the UK CE mark won't be recognised on the EU market. So products that require a CE mark will still need a CE mark to be sold in the EU. And in addition to that, products previously granted the conformity assessment by a UK-based notified body will see their CE marking rendered invalid. This is because, as I've said, UK notified bodies will no longer be recognised in the EU. If your products are affected in this way and they need both a CE marking and a UK CA mark moving forward, the best thing to do would be to contact the British Standards Agency, or BSI, because that's actually a notified body both in the UK and the EU, so they can issue both marks. It'll also be able to provide further guidance on the whole Northern Ireland market. So that's kind of, in a nutshell, why I believe it's the regulatory environment that's going to be most impactful to businesses as we move forward, not the tariffs. So trading goods, we're going to look at trading in goods specifically, and I thought I'd try to bring it to life a little bit with an example, albeit it's a very basic one. So I'm going to use the example of moving goods now, and then we're going to look at how that might change at the end of the year. So here, in my very basic example, we've got company X who manufactures preserves and condiments. This company imports its oranges from Seville, and it manufactures the marmalade here in the UK. So it brings those goods in from Seville. There's no import declaration required. There's no import duties or VAT applicable to the goods. There's no phytosanitary certificate required. Now, the company distributes that product domestically within the EU and overseas. And for its EU distributors, the company manages the transport to the company's premises. So it takes care of everything to get the goods to its distributors' premises. Now, the end product, so that lovely marmalade, is of EU origin, and it qualifies for zero rate duties in all countries where there is an EU FTA agreement in place. Now, export pricing, so the company's export pricing, that pricing in its destination markets, is competitive because of the lack of import duty and VAT and so on. So it competes well against other local market manufacturers and other international suppliers. Now, EU supply of oranges is dominated by Spain, as you might expect, with citrus fruits arriving between November and April. Something up to 100 vehicles per day arrive from Spain with citrus fruit alone. So all of these imports arrive, the goods move freely, and there's very little to no disruption to supply. Okay, so move forward to the 1st of January, should we not have a trade deal with the EU. And we can look at the potential changes or disruptions that might occur. So the company continues to manufacture preserves and condiments, so it continues to manufacture that lovely marmalade. It continues to import its oranges from Seville and manufacture the marmalade in the UK. But this time, an import declaration is required for those raw materials or those oranges coming from Spain. Those oranges are subjected to a duty of between 2 and 10%, depending on the time of year they're imported. There's a variation to the duty applied to oranges. A customs valuation will need to be completed to determine what we refer to as the ad valorem duty, as per the WTO valuation agreement. I don't want to get too detailed into valuation because we go into it on a different webinar, but ad valorem duty is the duty and import VAT that the business, so the manufacturer, will pay based on the value of the imported goods. Now, there are 6 different methods in total to value your goods, but the 90% of the world trade uses method 1, and that is what we call the transaction value. So that requires the manufacturer bringing in the oranges to calculate the price paid for the goods, to add in any delivery costs, so transport, insurance, loading, handling of goods up to the UK border. Probably not applicable in the manufacturer's case, but for other companies, any commission or brokerage fees, any royalty or license fees, any kind of containers or packaging. There's a whole list of things that can be factored into this customs valuation. But essentially what happens is, by the time the valuation is done, the amount that the manufacturer pays to clear those goods at UK customs can be significantly more than the actual price of the goods that might feature on the commercial invoice. So that's one thing to bear in mind sometimes when you're thinking about, the price of your goods. coming into the UK, actually it's not as straightforward as you think. There's a customs valuation that needs to take place. Once the manufacturer's come up with a customs value and he's paid his import duty and import VAT based on that customs value, he then has to keep that evidence supporting that valuation for 4 years. So if HMRC were to come and do a spot check or an audit, he'd need to be able to demonstrate how he came up with that valuation for that declaration. Now, the company might find that a duty deferment account would be of benefit, and they'd be eligible so long as they have a good compliance history and they're not at risk of insolvency. So that would be a way that they could defer that import duty and VAT and pay it, once a month as opposed to every single consignment. The imported goods, so the oranges, would need an accompanying phytosanitary certificate for customs clearance. And then one sticking point would be the origin of the goods. So the manufacturer would need to determine the origin of the finished goods, i.e. the marmalade, to demonstrate that the goods had been sufficiently transformed to be of UK origin. Now, why is this? Because up until now, as I said way back in a few slides, UK and EU content has counted towards the rules of origin requirements in EU trade agreements. So the UK manufactured marmalade made with Seville oranges is immediately of EU origin, as both the goods and the processing are within EU member states. But obviously, as the 1st of January, the UK becomes a third country, and the bulk of those raw materials, or the oranges, will be classified as non-originating. So the company will have to refer to origin rules to determine the origin of the marmalade. Now, in this case, when it's subjected to the 4 tests, the marmalade can likely be deemed of UK origin. Again, this is a very simple example, but you think about complex supply chains where you've got multiple components making up your bill of materials. This can get really, really quite complicated. But in the case of the marmalade, subjected to the 4 tests, the very last place that processing took place is in the UK, so that's a tick for condition 1. There was substantial processing done, tick 2. The processing added value to the finished product, so the value of the oranges being the raw materials didn't exceed, say, 50% of the ex-works price on the product, so that's a tick in that box. And then finally, the product and the raw materials undergo a level of manufacture that actually transforms them into a new product, which equates to a new tariff heading in the tariff. So the commodity code for oranges is obviously different to marmalade, so that demonstrates sufficient processing. Now, why is this important if we're kind of losing access to much of our trade landscape from the 1st of January? Well, essentially, proof of origin isn't just related to free trade agreements. It can be a requirement for non-preferential trade also. So there are some companies that wish to identify the origin of goods for statistical, trade control or political purposes. So origin has a national legal basis and it's mandatory on import and export. So a prime example of that would be the Arab League of Nations, where they require a certificate of origin for all imports because they want to know where those goods have originated. As discussed, in the absence of an EU-UK trade agreement, the company's marmalade will be subject to import duties within other EU member states. So the company will cease to have access to those EU FTAs, so it makes it more difficult to maintain its competitive export pricing. And the company will now need to make export declarations for all EU exports as well as those to the rest of the world. Now, under its existing commercial contracts, this is another one that's really important. You'll remember that I said that the company is responsible for getting goods to the premises of its EU distributors. So essentially, they're delivering under what would be delivered duty paid, or DDP. Now, historically, most intra-EU trade tends to fall into 2 categories, kind of door-to-door categories. So ex-works or delivered duty paid. And these terms were absolutely fine when customs processes weren't required. But obviously Brexit brings that level of complication. So DDP places the maximum obligation on the seller, so the marmalade manufacturer, in the same way that ex-works places the maximum burden on the buyer. And it's DDP is the only Incoterm that requires the seller to take responsibility for import clearance and payment of those import duties and taxes. Now, local market customs can be highly problematic for sellers. They can be complex, they can be bureaucratic, so they're really left best to the buyer who has the local knowledge. So in this case, the manufacturer might need to re-examine these terms with his EU distributors to save having to navigate those local customs formalities, pay those duties, and perhaps even register for VAT in the destination market. So there's a lot for that manufacturer who has pretty much had access to frictionless trade, been competitive in his export markets, kept his costs relatively low. He has a lot of things to consider moving forward for the changes that come in at the beginning part of the year. So sticking with goods for a moment, there are a lot of ways that you can start preparing. There's a lot more clarity around what is going to be happening, whether or not we reach an EU-UK trade deal. So EORI numbers are a climate example. These are required for all businesses moving goods into or out of GB, including those deferring their import declarations. I've provided further information at the back of the pack about applying. If you're importing from the rest of the world, you will have one anyway. I will be very surprised if you don't have one, because I think HMRC blanket bombed everybody with an EORI number last year, which has equated to some companies having two, which is a little bit complicated. But if you don't have one, then there's details at the back of the pack how to apply. But also consider whether you might need an EU EORI number as well. So if you ship, deliver duty paid to your customers, then you'll be responsible for clearing the goods at import and paying those local duty and taxes and carrying out any local customs formalities. Similarly, if you import under Ex Works, so where your sellers have made or your suppliers have made their goods available at their premises, and you're collecting under Ex Works, then you'll be required to make the export declaration in that local market. So in both of those cases, you'd require an EU EORI number in addition to a UK EORI number from the 1st of Jan. With regard to regulation, so we touched on that, but you need to familiarise yourself with any regulatory impacts your sector or products are likely to have. So speak with your federations, your associations, the regulators covering your sector, just to determine what it is that you need to do to prepare. Customs declarations, so familiarise yourself with the kind of documentation requirements your goods have in order to clear customs. So refer to the UK trade tariff and see what is against your commodity code. So are there any licenses, declarations, certifications, proofs of origin? Are there any required for your product? Two good sources here are obviously the tariff for imports, but with regard to exports, the government's where would you like to export to database, and also the EU market access database, which I've provided the links to. They're really good sources of information on those documentary requirements for goods going into the EU from the UK. So they're really need to be consulted. There are a lot of exporters in particular who think, well, we export, so therefore it's not as complicated as import. There's not as much preparation that we need to do. Actually, that's not the case, because the EU is very stringent on goods coming in from third countries, of which the UK will be one. Have a think about facilitations and simplified procedures. So these are kind of arrangements that you can gain authorization for that allow you to gain relief on import duty or VAT, but similarly suspend duty and VAT. So you might be able to make, for example, a simplified declaration and suspend duties and taxes when your goods arrive at the UK or EU port or airport. There's a number of them. So you can apply for inward processing. So you don't pay import duty and import VAT on goods that you import and then re-export. So that could be goods that you're processing, or goods that you brought in for repairs. Outward processing, no need to pay customs duty or import VAT on goods that you then re-import, so processing for repairs. There's temporary admissions, there's storage, such as customs warehousing, so you can suspend the duty and taxes until the goods are released from storage into free circulation. There's a lot of simplified procedures that you could just make use of that would release the burden of import duty and also speed up the flow of goods also. The other one I wanted to mention was check commodity codes. So UK goods will be subject to increased scrutiny and checks. So the classification of your goods is your legal responsibility. They're required for all customs declarations. So they dictate the internal taxes of duties. They dictate whether a proof of origin is required, whether the goods need any certification or licensing, and they provide, you know, those details of sanctions, embargoes and restrictions on those goods, so you know which goods you can import from which countries and which you can't. It's absolutely essential to check the commodity codes, because the wrong codes can result in you paying the incorrect payment of duty or incorrect filing of paperwork, which can obviously lead to delays, sometimes confiscation of goods, and in extreme cases penalties. Obviously, from an exporter's perspective, if you don't classify your goods correctly, then you're passing that problem down through the supply chain. So your buyers will be making their import declarations based on an incorrect commodity code. So they could be at risk of underpayment of duties and import VAT. So it's really important that you check the tariff code and make sure that the commodity codes for your goods that you're using are correct. There's a couple of things that you can do in case of doubt. So I suppose the first thing I wanted to mention was the fact that the tariff is an organic system. New commodity codes are being added all the time, so it's important to subscribe to updates, and I've given the link to how you can do that at the back. But also, if you're in doubt as to what your commodity code is, HMRC run the Tariff Classification Service, which is a free email service where you can apply and say, this is the commodity code I'm using, this is the description of my goods, is it right? And they'll come back and say, based on your description, you know, yes, that's right, or we suggest you use this tariff code. If you want something a little bit more formal, then you can apply for a binding tariff information. So that is where you might even have to submit samples to HMRC, but they inspect the goods and then they determine what the commodity code is. They issue with that, and that's kind of like a 3-year legally binding document that just gives you peace of mind that you're importing or exporting using the right commodity code. Origin of goods, so going back to the marmalade manufacturer, start to take a look at your bills of material to understand the makeup of your goods. So origin protocols vary from one trade agreement to another. And obviously we're totally uncertain as to what there may be in any EU-UK deal. But spending some time looking into this area could be time well spent in preparation for that deal, but also, you know, free trade agreements with other nations, or in the case of countries like the Arab League, as I mentioned, where proof of origin may still be a legal requirement for imports. In terms of import duty and taxes, familiarise yourself with the conditions attached to your commodity code in the UK trade tariff and the new UK global tariff. So understand what your obligations are there and what your import duty and tax liability is. Start to gain an understanding of how your goods are valued for duty and import VAT. So this is something that if you traded exclusively within the EU, you won't be familiar with. As I mentioned, Customs Notice 252 is the go-to document, or if you're stuck, then just, you know, drop us an email and we can help you out. Prepare for paying that import VAT on those goods coming in. So if you're a VAT registered trader, you'll be able to account for import VAT using postponed VAT accounting, as I mentioned earlier. If you're not registered for VAT and you're not using postponed VAT accounting, you'll need to report and pay import VAT through the customs process. However, if you're not registered for VAT and you have a duty deferment account, obviously those VAT payments can be deferred also. Leading nicely onto a duty deferment account. So if you import goods regularly, you might just benefit from having a DDA, as we call them. This enables you to defer customs charges, so customs duty, excise duty, import VAT, and it allows you to pay it once a month through direct debit instead of being paid on individual consignments. There is a requirement for a customs comprehensive guarantee, and that has put some companies off obtaining a DDA in the past. However, new rules announced in the border operating model just last month are going to allow most businesses to operate a DDA of up to a maximum of 10k in any one month without a guarantee. So that is welcome for a number of companies. Take a look at your export pricing. So consult the government's where would you like to export to and the EU market access database to understand how local market duties and taxes are going to impact your pricing competitiveness once we become a third country. And our access to those EU trade agreements is removed. Commercial contracts, review them to first understand if they refer to any terms that might no longer be relevant post-transition period or that might raise legal or practical questions in the future, but then also look at them to understand what your obligations are with regard to transport and delivery. So look to renegotiate where Incoterms are too burdensome and you bear too much risk. Intrastat, make sure you know what your obligations are here. So no change for importers, but no need for exporters to file post the 31st of December. And customs intermediary support. Customs declarations are complicated. The majority of businesses that currently trade outside of the EU use an intermediary, such as a customs agent, or a fast parcel operator, or freight forwarders, or a broker, to help them meet these requirements. And a good one can be worth their weight in gold. You can't forget that because most customs intermediary will work for you in a direct capacity. So they operate on your instructions. So typically the buck stops with you. They won't share that liability. So you have to be sure of the accuracy and of your declarations and make sure that you're compliant. So there is a lot to think about, but hopefully that has given you a flavour of the kind of things that you could be doing. Now we're going to move on to trading and services. So much of the negotiation to date and pretty much all of the press coverage concerns trading goods. Yet, as I mentioned earlier, the UK is very much a services-based economy, and services companies need to prepare too. So this slide just shows how reliant the UK is on service exports. If we compare our figures to those of the US, France and Germany and the EU as a whole, we actually operate, as I said earlier, a trade surplus in services and a trade deficit in goods. The EU is our largest market for service exports, and within the bloc we export the most to Germany. That accounts to 6.6% of our total services exports, followed closely by France, accounting for 5.7%. So the EU is a big part of our services economy, if you like. Here on this slide, I provided a breakdown of services exports by type, so it becomes really clear why much of the ongoing negotiation challenges, if you like, surround financial services, given their importance to our economy, but also our strong position and brand equity in the EU member states. So the City of London has become the leading financial centre within the EU, so our financial services exports are significant. If we refer to the way services are traded currently, there are effectively 4 different modes. And as a part of the single market, our businesses enjoy the 4 pillars of freedom, so those goods, services, people and capital. So service delivery is frictionless. There's 4 different modes. There's mode 1, where we have cross-border sales, where the service itself crosses the border. And in that particular scenario, we see that a lot with management consultancy, ITC, marketing and so on. Then we have where the consumption is abroad, where the consumer travels across the border. So we see this in tourism and travel, education and training, legal, health services. Then we have mode 3, which is commercial presence. That's where we've been allowed to set up legal entities in one of the other 27 member states. We see that a lot in finance, insurance, distribution. And then we've got movement of natural persons, so the supplier travels across the border, and we see this a lot in arts and culture, recreation and sporting, education and training. So it's been frictionless. It's been absolutely frictionless and can operate in those 4 modes. Now moving forward, our services exports are so reliant on free access to our closest neighbours that I suppose failure to achieve this with a trade agreement is going to have impacts on our business and economy. There's absolutely no doubt. So I've provided kind of some examples or scenarios of how the landscape could change in the absence of a really comprehensive and closely regulatory aligned trade agreement. So the first example, using the first mode, which is cross-border supply, as we said, that's where services are supplied across the border without a supplier or a purchaser physically moving. So an example of this would be a UK customer uses a call centre in France. So once we've left the single market, it might be that there's a requirement for the foreign service provider to establish a commercial presence. It could be that the regulations on consumer protection can negatively impact that service provision, if you like, and it could require, for example, that UK bank to open a branch in the EU to sell banking services into the single market after Brexit, which we've actually seen happen a lot in the financial services side of things. Mode 2, so service consumed by a resident in another country, and the example I've used here is Spanish nurse training in the EU. Moving forward, there could be travel restrictions where the service supplier is based and where the service is offered. There could be regulations relating to the domestic recognition of overseas degrees and training, and that recognition of qualifications is a big one for the UK moving forward. So, example, it's limiting the recognition in the EU of qualifications earned within the UK, and like I said, that is a real pain point for the UK negotiations. Mode 3, commercial presence. So this is where the service is provided by a foreign company opening a branch. So we could see restrictions on the establishment of new service provisions. So there could be the introductions of policies that just make it difficult to set up overseas. And again, you know, how that equates to overseas providers having to access additional licenses, which put them at an unfair disadvantage, you could say, to other domestic competitors. And then finally, we've got the movement of natural persons, so where the service is provided by an individual who travels to the country of purchase, so a UK lawyer travelling to Belgium to provide legal service. So moving forward, there could be visa requirements. We now have visibility of entry requirements for business personnel for all of the individual member states, so it's important to consult those. But there could be visa requirements depending on the length, the duration and the type of stay. There could be quotas on the inflow of temporary workers, and there could be limits applied to the duration of a stay. So that just adds additional paperwork, clearances before a service provider can service an EU-based client. So many impacts there. So what does it look like really moving forward? I suppose that the dominance of the EU for UK services exports really isn't surprising. When you think research shows that trade flows, even in services, are typically greater between neighbouring countries, but UK services reliance on the EU really reflects the degree of market access that's much greater within the single market than could ever be facilitated by a free trade agreement. So, for example, in the EU, regulation of individuals providing a service like, say, an architect or somebody like that, the trade in services between EU member states is actually easier than it is between some US states. So the single market provides so much freedom, really, to allow our services-based companies to apply their trade in the 27 member states. Now, economists estimate there'll be significant impact on UK services when we leave the single market. You know, the National Institute of Economic and Social Research said that trade and services could reduce by 60%. I think that's very negative. But there's ultimately no doubt that free trade agreements and GATS just can't replicate the freedoms of the single market. It just can't be done. So where are we at? Well, the UK clearly wants a future relationship with the UK and the EU based around what they refer to as a comprehensive free trade agreement, so accompanied by a limited number of supplementary international agreements around law enforcement, fisheries and transport. But the EU, where we get to this impasse, is the EU favours a single comprehensive agreement that reflects everything in the agreement, all linked under one deal. Up until now, a lot of the sticking points have been around passporting rights for financial services companies. So the UK is pursuing its EU-Canada comprehensive economic trade agreement, but it also wants a modified version. It kind of wants its cake and to eat it. Now, some companies have already executed plans to circumvent the loss of passporting through setting up in EU member states so they can continue to access EU clients. There's also, just as I alluded to a second ago, that mutual recognition of professional qualifications. So currently, UK professional qualifications, such as those needed to practice law or architecture, they're all recognised throughout the EU. And obviously continuation of this recognition is crucial for the business services sector. But the EU's position is that this recognition of those professional qualifications should be governed by the national policies of the individual member states. Now that just leaves far too much ambiguity and uncertainty for the UK, so that's a major sticking point. Data and digital services is another area that has caused a lot of pain. So the UK is seeking commitments to minimise the barriers to supplying digital services between the UK and the EU. Currently, that's achieved through GDPR. You remember GDPR of a few years ago, we all jumped through hoops for that. But the Commission applies quite rigorous testing of third country data protection principles to assess whether it's of what they call an equivalent level. So if the EU insists on doing that, even though the UK is going to maintain GDPR in its domestic law, we could still have to jump through hoops to be seen as our provision to be seen as adequate. So this could lead to considerable uncertainty for businesses. Logistics and haulage services. So the UK wants an agreement that allows liberalised transport services to continue within the EU. And whilst the EU's trade deals with Canada and Japan don't provide a template for this, the EU are kind of like, well, how do we treat this essentially? But the EU does have a bilateral road transport agreement with Switzerland, so there is kind of like a precedent there. So this could be resolved with some goodwill on both sides. And then finally, the audiovisual sector. So that's the sector including film, TV, and TV-related businesses. This is one of the service sectors where the UK and the EU have been farthest apart. So in common with its other FTAs, the EU is proposing that the audiovisual sector should be excluded from any deal with the UK. But the UK has included this sector in its draft agreement because it's a really, really important sector for the UK. It's the largest in the EU, so it's 20% larger than Germany, 50% larger than France. So it is a big services sector for the UK. So that's another big sticking point, if you like. So things that importers, exporters of services should be looking at. So intellectual property is a big one. So conduct or look to conduct an IP audit. So looking at patents, trademarks, copyrights, etc. Assess your dependence on IP protection in the EU and what the risks are of losing such protection. Perhaps start with the Intellectual Property Office for generic advice, but then look, depending on your vulnerability or your exposure, look to consult with legal and IP advisors just to make sure your IP strategies are Brexit proof. Data, so the government has confirmed that the data transfers from the UK to the EEA will not be restricted, so there's no further steps to take in that regard. However, if you receive, process or store EEA customer data, then you'll need to incorporate what's called a standard contractual clause into your commercial contracts. The Information Commissioner's Office, so the ICO, has some really good sample clauses and help you determine which one's most appropriate for you. So look at your data flows with EU member states and familiarise yourself with measures that need to be implemented. Overseas business travel, again, some of these apply to trading goods as well. I shouldn't really have split them out like this, but overseas business travel, there are a number of changes you need to be aware of with regard to business travel within the EU. So things like minimum time left on passports, to increased insurance requirements and border control. So I'd say consult the specific entry requirements for each member state, which they're now available on the Gov.uk website. And these requirements change depending on the destination, frequency and length of stay. So it's important that you're up to speed with what they are. EU employees, have all of your EU employees registered for the UK settlement scheme. They need to have done this to continue living and working in the UK after the 30th of June next year. If you have UK employees based in the EU, so turning it around, check the terms of residency and employment within the jurisdiction where they're residing, because they may need to make an application to stay within that country too. Employing EU nationals, so are you familiar with the process of employing EU nationals after the 31st of December? So the UK introduces its new points-based immigration system, so you will need to register as a licensed sponsor to hire eligible workers from outside the UK. Now that takes approximately 8 weeks, and there are fees that are payable as well. So It's important to get your head around that. In terms of regulation varies greatly from different service sector industries, and it tends to be most stringent in the case of finance, aviation and healthcare. So if you're operating in a sector that's highly regulated, speak to your regulator to ensure that you're taking the right steps to mitigate the impact that Brexit might have. Again, regulators and federations and associations have been lobbying government for the last 4 years, so they'll be very much up to speed with what you need to do. The last few years have seen incredible currency volatility. I don't think it's over yet. So look to take measures to manage your exposure to those fluctuations and closely monitor any risks that may emerge. Contractual and legal challenges could emerge with that kind of cross-border service level agreements or SLAs, impacting licensing, insurance policies and data transfers. So you might not be covered or protected, or your contracts recognised after the 31st of December. So review your existing contracts and trading agreements, I suppose prioritising the most strategic ones, and obviously moving forward, employ caution when you're entering new contracts with EU-based parties. And then finally, VAT, a big one. Are you aware of your VAT obligations? So where is your place of supply? Is it in the UK? Is it in the EU? And that'll dictate where your VAT is applicable and where you need to be registered. Okay, so whizzing through here, I promise not to keep you too much longer. I just wanted to cover off quickly negotiations. So obviously they began on the 2nd of March. The UK laid out its stance very clearly in terms of what it wanted. There are huge impasses. The long-standing issues have been fisheries and that level playing field, so that state aid that could place, the EU believes that could place UK businesses at an unfair advantage compared to its EU counterparts. Obviously with COVID, the schedule is significantly impacted, and really we're talking days now in terms of being able to strike a deal, because whilst the ratification process is really easy on our side because we're just, we're one nation. I mean, it does take the House of Commons to actually agree on something, but it's relatively easy when you consider how complex it is on the EU side and getting, those member states all aligned and agreed, if you like. You'll probably remember in the press that after the 9th round of talks, the discussions kind of broke down, but there were some positive new developments, so around aviation safety and fundamental rights and individual freedoms and judicial cooperation. They were good ones. However, there was minimal progress made on protection of personal data, so that whole GDPR piece, and also climate change commitments. What's outstanding still is the state aid issue. Commitments from the UK that it won't regress from, those regulatory areas. And I suppose the government's internal market bill that kind of looked to, affect the Northern Ireland Protocol, that made a number of the EU markets feel decidedly uncomfortable. So there's now extra focus on having that clear governance framework that has a clear path for enforcement and dispute settlement. And then of course fisheries is still a big one. So is there scope for compromise? Well, we haven't reached it yet, but today Michel Barnier and David Frost are briefing their respective administrations, so we may hear something later on today. But again, I reiterate, just as I said earlier, even if we strike a deal this side of Christmas, implementation will take years. So very quickly, I have provided at the back of the pack, which you'll all get a copy of the slides, basically your action plan, if you like. And the points I would probably make on that are, if we scoot down to obtaining, understanding what your obligations are at borders, for example. So you need to understand the documentation for imports and exports, whether there's any licensing or certification or proof of origin or pre-notification. Do your goods require an import pre-notification? Do they have to enter via a border control post? Do they require documentary identity physical checks at the border? Do they require special certificates or licensing? whole host of stuff, and you find that again, like I said, in the UK trade tariff, but also in a couple of the other databases that I mentioned. And then the last thing really I wanted to pick up on was, even where, so it's really important that you understand your legal obligations. So even where you have appointed an agent to manage your imports or exports, it remains you who are responsible for correctly declaring your goods. And there's really typically negligible liability placed on the agent. So understanding customs obligations and taking steps to ensure compliance is essential if you're to avoid issues that are linked to non-compliance, like supply chain delays due to increased inspections, maybe the withdrawal or refusal of certain benefits. So any simplification procedure authorizations that you've had, they may be withdrawn, any customs civil penalties or any financial penalties. So it's important that you understand the process. Now, HMRC has allocated in excess of £100 million worth of grant funding. So eligible organisations can apply for funding for recruitment or employee training or IT when they're preparing for these additional customs declarations. So your local Chamber of Commerce, the Institute of Export, they all offer very affordable and accredited courses on customs documentation and compliance. So their training would be covered by the grant that I mentioned. So I've included the links to the HMRC grant funding and also the links to the chambers and to the Institute of Export at the back of the pack. So gain that knowledge essentially, and why not obtain the funding for getting it. So at the back we've got, I won't go through all of them, but basically everything that I've covered on this session today, you have all of the links to that stuff on, so you're signposted to the right areas. The upcoming webinars will talk a lot more about importing post-transition period and exporting post-transition period, so we'll do particular deep dives in those areas, but hopefully this has given you an overview of how you can optimally prepare for however days we've got left. So that is it from me. I apologise for droning on quite so much, but there you go. Are there any questions?
Yes, thanks, Andrea, for
You're welcome.
Very detailed and comprehensive overview. I mean, it's complicated.
Put my video back on. No, that's absolutely fine. It's a huge topic, and I appreciate some attendees may have already done a lot of preparation, but I may just have pointed them to things that they've maybe not considered yet as well.
Yeah, thank you very much. Are there any questions from the audience, please?
This always worries me. This is either I've put them to sleep, or I've lost them, or I've covered it so comprehensively that they understand everything, and I'm not quite sure which one it is.
Everybody is still here, so okay. Well, if you have any, you of course can contact us afterwards. You will receive the recording and the slides from Andrea, as mentioned. And if you've got any specific query, please refer to your local growth hub, and the details will be on the slide shortly. So please contact your growth hub for any information or any questions you may have.
I think I'm just looking at the chat here, so people are asking for a copy of the recording. I think you are. I think you have recorded it, haven't you? So that will be available, and obviously a copy of the handouts also will be available. So that's absolutely fine. So and again, happy if there's any questions that come to light as you get off this call and you're thinking, or you're applying some of what we've discussed to your own individual circumstances. If there's anything that pops up, then by all means get in touch with the Growth Hub. They can refer it to me, and I'm quite happy to answer your questions.
Yeah, thank you, Andrea. And we've also got